Hey everybody, Jeff Bangerter back with you. So to continue the conversation about 1031 exchanges into the DST, or Delaware Statutory Trust, I want to talk a little bit about taxation, because really there are a lot of advantages that the 1031 and the DST provide, but there's some disadvantages too, right? There is no perfect investment, and so I think this is really a good place to make sure you understand everything. So when you think about the use of a Delaware Statutory Trust, why aren't they using some other type of tool, like it could be a limited partnership or a corporation or an LLC? First off, the law says that in order to qualify as as direct ownership of real estate, it has to be the Delaware Statutory Trust. So, that's the bottom line right there. So, anyway, what we really wanted to utilize is this tax deferral. It's not tax-free, and I want to make sure everybody understands this. You're deferring the tax each time you do a 1031 exchange. You're deferring it longer and longer, and ultimately, if you defer until you ultimately pass away, then your heirs get a step up in basis, and all of that past taxation is forgiven. And that's really the main advantage. So when you think about, if you were to just sell, say I'm really tired of dealing with my rental properties and the tenants and all of the stuff, right? And so now you want to go ahead and sell. Well, you've been depreciating that property all the way along. So now you're going to have a 25% depreciation recapture. So let's just say that you had depreciated, let's use easy numbers, $100,000. You'd owe $25,000 in tax and just depreciation recapture. They gave you a benefit, they want it back, pretty much. Then you're going to have the tax on long-term capital gains. So it's going to be minimum 15% as I'm doing this in 2019, as I'm recording this, and could be 20%. So 15 to 20%, most of our clients are in that 20% range, just because they have other assets and you're selling a large asset, it pushes you into that 20% pretty quick. And then there is a 3.8% Obamacare tax still on the books in 2019. So if you sell a significant enough piece of real estate, you're going to owe that additional 3.8%. And then here in California, we have a lovely tax situation. There's not a long-term capital gains tax. It's just the income tax they charge you. Same rate. Minimum is 9.3. It goes up to 13.3 pretty quickly. So if you start adding all of these things together, right? Let's say you had $1 million property, or let's use $1 million gain, just to, again, keep the math kind of simple. If you've depreciated that entire $1 million too, then you're going to have $250,000 there. Maybe you didn't depreciate all of that. Maybe it's still just $100,000, that you owe there. So no really big deal, but still significant. So you're going to have to deal with that. But just the capital gains tax, 20% federal, 3.8% Obamacare, and another 13.3% here in California. That's a big hit. And maybe you're not in California and you're only going to pay 6% or so in state tax. Okay, so 26, 29, almost 30%. So you can pay 30%, $1 million, $300,000. I've had clients in here, they can't believe it. They've built this wealth up all their life and the government wants a third of it, essentially, right? So it's a big hit. So I want you to be aware of that. This is the main reason to do this. But there's other tax advantages. So the Section 1031, right, you're going to still own real estate. So that real estate, you're going to get all the benefits of owning real estate. So you're going to be able to continue to get depreciation. You're going to get the write-offs for all of the repairs and interest write-offs and all the stuff that goes on in the normal real estate environment. So this is going to be a highly tax efficient investment. And let's say that you have no debt on your property and you buy a property and you want to get a lot of tax benefit, and we put you in a property that's just, let's use 50% leverage, right? So it's got a mortgage, 50% mortgage on it. Well, so your $1 million would be buying $2 million of real estate, and you'd be depreciating $2 million. Obviously, we still have to keep your depreciation in the mix too, but we've increased the amount of real estate that you own so that you can get a better tax benefit from this transaction. So I think this is really a great opportunity to save a lot of things in a tax strategy. So, and again, once you do this, no more dealing with the tenants, toilets, trash, no property taxes that you have to worry about. So that's gone too. And I think when you really do the net math, right? I have a lot of clients come in and say, oh no, I'm making this really great 5 or 6% return, okay? But I had to spend $80,000 last year in repairs, and I had to do that, 5 years before that, 5 years before that. And so, you have to net out all of that, all the repairs. That's expense to you, right? So I want you to do the calculation based on how much do you net, minus your homeowner's insurance or property insurance, right? Minus management, if you're paying somebody to manage it, minus everything. What are you really netting? Here in California, we find most people are netting about 3%. So you've got $1 million asset that's netting you 3%. So this is an opportunity to take advantage of the tax laws and do better, right? So it's not a tax loophole. I want to make sure everybody knows that too, right? A lot of people think, oh, I'm doing something really aggressive. No, you're not. This has been around since 1921. This is all defined by the Internal Revenue Code. This is code. This is not some new thing, right? So you have an opportunity to take advantage of this, and it's all part of the tax law. There is no, the IRS isn't going to look at you any harder about this. And again, they just reiterated all this in the 2017 Tax Cuts and Jobs Act. So it just confirmed that this is an important part of our economy, important part of our tax law. So I think this is a real good opportunity for folks to, again, go passive. It's just, I think, a much better situation for a lot of folks. Not for everybody, but for a lot of folks. So thanks for watching. If you haven't already, grab a copy of my book. Give us a call. We'll shoot you a copy of it. My toll-free number hasn't changed in 30 years. 800-451-2351. So we're real stable. I've been doing this, been in the financial industry since 1979. So we can help you. Give us a call. 800-451-2351. Thanks.